If you are a beginner or are still struggling, then this video is for you. Because in this video, I'm going to explain why you should ignore the lower time frames like the M15 or M5 and instead focus on this one time frame. I've seen many traders attempt to scalp the market using the lower time frames and end up blowing their accounts. They have no understanding that it takes a lot of experience to trade the lower time frame. And hey, that's not considering the fact that you are still paying the same spread regardless of whether you are scalping or swing trading. If you are scalping and each trade you average about 10 pips in profit, then you are paying about 10 to 20% of your profits in spread costs. This is not accounting for the fact that you are probably taking multiple positions a day. You may not feel it, but these spread costs does add up. Now contrast this to a swing trader who averages about 100 pips profit per trade. The spread cost is relatively insignificant to the swing trader. Anyhow, my point is that it takes a lot of experience to scalp on the lower time frame, and the odds are stacked against you. And that explains why most traders lose money and blow their accounts. With that being said, I can hear you asking, just tell me what time frame to stick to already. Well, the time frame that is best suited for beginners is the daily time frame, not the M15, H1 or even H4 timeframes. In this video, I want to explain why I believe that the best time frame for beginners is the daily time frame. I don't want you to be like a mindless subscriber who takes whatever I say and follow without understanding. I think that it is essential that you understand why I recommend the daily time frame. And hey, my job is to convince you so that you will ultimately stick to the daily chart. If I don't provide you with the explanation, it's highly likely that you will not follow through and perhaps start playing around with the lower time frames. So if that sounds good, please do me a small favor and hit the thumbs up button. If you are new to the channel, do subscribe to the channel because we release new Forex trading tutorial videos like this every single week. We also run a successful Telegram channel where we send out our signals each day. So if you have not joined our free Telegram channel, do click on the link in the description to join us. Now, the first thing you need to understand about the Forex market is that there are three major trading sessions: the Asia session, the Europe session, and the US session. Now, when you see a day close on the chart, what it is saying is that all three trading sessions have concluded. So, if you look at this chart right here, this is an obvious resistance level. When you see a day close above the resistance, what it is saying is that after all the fighting between the Asia session, the Europe session, and the US session, this is the outcome. Now let's be logical here. Which is higher probability? After all trading sessions have participated and a level is broken, or only when a single trading session breaks a level without considering the other two trading sessions? Well, I think it should be pretty apparent that the first scenario is the higher probability one. This is also the reason why I don't recommend trading the lower time frames. What often happens when a beginner trades the lower time frame is that he enters a breakout trade during the Asia trading session, something like this right here. He has no concept about the different trading sessions, or perhaps he does, but he doesn't understand the importance of waiting for a trading session to firm up the direction. He holds on the trade going into the Europe trading session. Well, the Europeans don't agree that the support is broken and pushes the price back up. That results in a loss for the trader. In fact, if you are part of our Telegram channel, then you will always see that we tend to reduce our risk going into a new trading session. For example, If we were long Aussie yen in the Asia session and there's not much momentum in the trade, we will tend to exit it by the European trading session just to be safe. We might observe the Europe session and re-enter the trade. It really depends. There are instances where we hold a trade past the trading session as well, but that's based on our own view of the market and up to our discretion. For most beginner traders, they don't yet have that experience. Or worse still, they trade a breakout just going into a new trading session, which isn't wise. It's better to wait for the trading session to settle in. So let me quickly give you a case study of what I mean. Right here, if you have a look at the chart, you will see a nice shooting star. And if you were to drill down to the lower time frame, you will see that the Asia session was bullish. When the Europe session started, it started to reverse and erase the gains made by the Asia session. When the US session starts, price starts to drop further, and thus we have this shooting star pattern on the daily chart. Now, if you traded long with the Asia trading session's momentum, then you would have lost money. But if you had waited for the daily chart to show you the shooting star candle and went short instead, you would have made money on this trade. I hope this case study encapsulates why you should stick to the daily chart if you are a beginner. The next thing worth mentioning about trading the daily chart is that you do not need to worry about economic news. Economic news can move the market and spike price intraday. This means that you need to be very careful with how you set your stop loss. If you trade the lower time frames and do not pay attention to these news events, it can be quite a painful experience. Perhaps you enter a trade at 8:28 p.m. not knowing that there's a piece of high impact news at 8:30 p.m. And within 2 minutes, you are stopped out of your position. And worse still, the spread widens during the news event and you get stopped out at a bigger loss due to slippage. This has happened to me multiple times before. Since then, I always make it a habit to check the news and take that into account whenever I'm trading the lower time frames like the H4 or H1 charts. A quick tip I have for you is to use tradingview.com charts, and you can select the option right here to show economic news on the chart. This way, it is less likely that this will happen to you if you are adamant about trading the lower time frames. These issues that I have highlighted earlier can be avoided if you stick to the daily time frame. You do not need to worry about the 3 different trading sessions because the daily candle will objectively tell you the outcome after all 3 trading sessions have concluded. You also do not need to worry about economic news and set in the proper stop loss because you're not worried about the intraday spikes. When trading the daily time frame, your stop loss will be above or below the daily high or low, and that would have already accounted for the intraday spike in price. So hopefully you are convinced that trading the daily time frame is way easier. You also don't need to check the charts as often. Perhaps just every morning before you go off to work, and maybe another time when you come back. Summing up this video, I recommend sticking to the daily time frame if you are a beginner. You will pay less in terms of spread, but more importantly, the daily time frame will ensure that all 3 trading sessions have concluded and help you make better trading decisions. Now, in this video, I didn't address how to trade using the daily charts. So if you are new and need a trading strategy based on the daily chart, I recommend checking out the MPE trading strategy that I have previously uploaded right here. Thanks for watching, and don't forget to subscribe. I will catch you in the next one.